Now, Sanchit, I believe it's to you.
Yes, hi, Adam. Yes, I'm here. I'm here. I'm just going to project my screen. Yeah, may I start, Adam? Yeah, thank you. So, thank you everyone for giving us the opportunity to present this paper. It's a pleasure to be here, and I see a lot of familiar faces. Great to see everyone back. So today I'm going to talk about, before I start talking about it, I realized I came to my understanding that Josh has an earlier version of this paper, which was almost written like 4 to 5 months back before we started working this paper. I hope this presentation sort of handles a lot of concerns that he has during his time. So going back to this presentation, so the paper that we've been working on is titled Capital Account Liberalization. Capital account liberalization in India, an analysis of onshore offshore arbitrage. So this is a paper co-authored with Nidhi, who's at IIM Udaipur, and Rajeshwari, who's at IGIDR. So as the name suggests, that we're interested in understanding what is the status of capital account liberalization in India. Now, to give you a summary of this paper, the objective is to decipher the openness of India's capital account. So we're very clear that we want to see where India's capital account is at the moment and what is the trend overall in the past 2 decades. Now, how do we do it? We we calculate CIP deviations between the onshore offshore rupee market. I'll talk about what this offshore rupee market is in a while. And then we also estimate no arbitrage bands using a SETAR model. The key result is that India has become more financially integrated with the global markets, that we see because CIP deviations have become narrower over the last 2 decades. And we also see that these no arbitrage bands have become narrower. They're around 0 a lot now. When it comes to policy implications, as the trilemma that we are aware of, a greater capital account openness, as we see, plus independent monetary policy, if that exists, then it leaves limited room for stabilizing currency fluctuations. Now, just a few days back, the RBI Governor, Shaktikanta Das, he said that capital account convertibility would be a continued process rather than an event. And even as the country has progressed quite considerably towards full convertibility and internationalization of financial markets. So this statement begs the question, has India's capital account become more open? And is there any evidence of that? So this sort of motivates us to understand where our capital account what's the status of capital account liberalization. Now, to give you some background, so there are 2 viewpoints when it comes to capital account liberalization. And so one, those who are in favor of it, they talk about more efficient allocation of resources that it offers. It also leads to more productivity and economic growth, risk diversification. And also one can tap onto the global financial savings. And when it comes to people who are against it, they talk about risk associated with large and volatile cross-border capital flows, which can be harmful to emerging market economies, and it could also lead to a lot of economic distortions. Now, also in terms of, it also has implications in terms of macro policy. So the trilemma of independent monetary policy, stable exchange and capital account liberalization, it gets affected. And accordingly, one has to decide on the macro policy. Now, in the last 3 decades, so in the last 3 decades, cross-border flows have increased. And that is not just the case with India, but all the emerging market economies. But yet emerging market economies, they keep experimenting for multiple reasons, either to tackle appreciation, depreciation, or inflation, etc. So they have their multiple reasons. Now, whether capital account liberalization is hurting or helping the economy, what we are interested in first is to understand how open or closed India's capital account truly is. Now, there was a lot of discussion about de jure methods and de facto methods in the previous presentation, and now the same applies to this literature as well. So how do we measure capital account openness? So there are 2 measures. Again, so there are the de jure method and the de facto method. So the de jure method is basically about constructing indices using legal restrictions that are imposed by various countries. Now, the most important and cited ones are the Chin-Ito index and the Schindler index. So they use capital controls data that is published by the IMF. However, they fail to capture the intricacies owing to their low frequency and binary approach. So if restrictions continue to hold, they'll always treat that if the restrictions continue to hold, they'll consider it to be closed rather than a gradual approach. Now, when it comes to the de facto measures, they help us try to understand how open a country's capital account is. It is truly based on the data. Now, within de facto, there are two categories: quantity-based measures and the price-based measures. Quantity-based are mostly about how inflows and outflows are as a percent of GDP, and whereas we are interested in price-based measure, which is the covered interest parity. And that's what I'll discuss in the subsequent slides. Now, why are we interested in India? So while there were liberalization reforms in 1990s, and there have been gradually all the restrictions on cross-border flows have been gradually relaxed, but new restrictions are also imposed from time to time. So these frequent changes make India a good case study to analyze capital account liberalization, and it's forever that we've been talking about capital liberalization. So it's good to understand where this trend is headed. Now, how do we study liberalization and the trend of it? So we calculate CIP deviations between the NDF implied interest rate and the domestic interest rate. So the domestic interest rate is quite clear. What NDF implied interest rate is, I'll discuss that in the next slide. We identify regimes in CIP deviations to figure out whether this liberalization has followed different regimes in the past 2 decades. And then we also estimate no arbitrage bands. Now, before I get into that, I just want to spend a couple of minutes on what this rupee NDF market is for people who aren't aware of this. So when capital account restrictions prevent, say, international participants to take positions in the onshore currency market, either to hedge or to speculate on the currency movements, so an offshore NDF market comes in to address the gap. So the characteristics of this market is that there is no physical settlement, right? So at the end of this contract, it will not be settled in rupees. It is largely a USD settled market. It's the over-the-counter market, and it is situated in about 5 to 6 offshore locations: Singapore, Hong Kong, London, Dubai, and New York. And Singapore is the largest given the time overlap. It is also a mostly unregulated market because Indian authorities do not have jurisdiction over other countries and how they operate. Now, one thing that I want to talk drive home is that the offshore NDF rate, that is more of a market determined rate because it is outside of the capital controls. So there are no restrictions as to who can participate in the market. So it is more of a market determined forward rate. And the implied yield that we derive based on the CIP deviation is the interest rate that would exist in the absence of capital controls. So keeping that in mind, we calculate the deviations. But before that, let's talk about some of the facts of this rupee NDF market. So this NDF market has reported a staggering 3-fold increase from almost 16.4 billion in 2016 to 50 billion in 2019. And when it comes to market share, this offshore NDF market now accounts for almost 82% of the total forwards in USD INR, which was 74.3% in 2016. And when it comes to global share, India accounts for almost 18% of the global trade in NDFs. So almost 1 in 5 trades. Now, how do we calculate NDF implied interest rate? So not going to get into the CIP equation, but if you have a CIP equation wherein you have forwards, the forward rate, then you have a spot rate, you have a foreign interest rate, then you also have a domestic interest rate. So now when you rearrange, when you put in the forward rate, spot rate, the international interest rate, rearrange, you get an implied interest rate because you put the NDF forwards rate here. So you get an NDF implied interest rate. You compare this with the interest rate that exists in the Indian market. The difference is what deviations are. This is what we're calling CIP deviation, and this is what we study. Now, what do these deviations mean? Right? Ideally, these deviations should be zero, right? The interest rate that exists in India and the interest rate that is implied, they should actually be close to each other, and they should ideally be zero. The only difference should be because of some transaction cost that exists in the market. And if there is one-off deviation that goes way above or way below, that should actually come back to zero immediately due to arbitrage opportunities. Now, if there are persistent deviations, then it is likely due to effective capital controls that prevent the equation to hold. Now, in case there are persistent negative deviations, if the domestic interest rate is lower than the interest rate implied by the equation in which we put NDF, then it implies that there are effective capital controls on outflows. And also there is a depreciation pressure on the home currency. And when there are persistent positive deviations, as in when the domestic interest rate is higher than the NDF implied interest rate, that means there are effective capital controls on inflows and appreciation pressure on the home currency. So we look at 1 month NDF contracts data, which is from Thomson Reuters and Icon database. We also take spot INR USD rate from there. We take 1 month LIBOR from Federal Reserve Board and 1 month MIBOR from Reserve Bank of India. So we almost cover 2 decades, starting from August 1999 to July 2019, and our data is daily. Now, once you calculate CIP deviations, this is how deviations look like for the period of 20 years. If you look at the mean of these deviations over the past 2 decades, it's about 0.73. So it's close to 0. One would say that, it's close to 0. The capital account is relatively open. But when you follow these CIP deviations over these 2 decades, you would realize the deviations were all negative to begin with, became some positive here. Then there was high volatility during these periods, and there has been a trend to become tightly knit around 0 in the later years. This is what we see around here. So we wanted to understand, are there any different regimes that India followed in terms of capital account liberalization? So we used structural break tests to identify structural breaks in CIP deviations. As one would know that these structural break tests are sensitive to specifications. So what we do is we try structural breaks with various specifications, and we identify those dates which are common across various specifications as our breakpoints. So there are 6 regimes that are existing that we identify, one starting from 1999 to 2002, and then one from 2002 to 2005, August 2005. Then from 2005 August to 2009 August, then 2014 Feb, and then 2017 March. Now, if we go one by one through these regimes, so first regime where the CIP deviation is about -3. And as I said before, if it's negative, it implies that there is a depreciation pressure on the currency and also effective controls on outflows. And this was also the period when the GDP growth rate was moderate. Now, when we move to regime 2, this is the period when we observe that the mean of the CIP deviations is close to 0. So it seems that the capital account has probably started to open up. This is also the time when India was booming, about the GDP growth was 8%, and there were likely inflows. So it sort of correlates with that we have positive deviations, and there are controls on the inflows. The third regime, which is the second largest regime that we have out of these 6 regimes, this is the period when which coincides with the subprime crisis. This is the period when most of the deviations that we see are negative, and the mean is about -0.3. So while we did see that the mean deviations come down from first regime to second regime, in the third regime, that sort of gets, we do see a roadblock, especially because of the subprime crisis. Now, most of the negative deviations again imply that there is an effective control on outflows. Now, how strong was that? We'll come to that using the arbitrage bands in the subsequent slides. Now, when we come to regime 4, this is the largest with the most observations, and this is the period when.
This is just a 2-minute warning.
Oh, it's okay. Okay, so I'll just quickly go through it. So this is regime 4, wherein we again see that the mean is about 0.4. It again seems that we were back on track on capital account liberalization, and this trend has continued for the next 2 regimes as well. Now, ideally, these deviations should go back to 0, but because there are capital account restrictions, transaction costs, they are not close to 0. So what we do next is we estimate these arbitrage bands. So arbitrage would occur only when these deviations are beyond these thresholds, not within these thresholds. So when we look at these deviations, when we do look at these arbitrage bands as well, we see that in the regime 1, the difference was say 6.6. So the deviation had to be large enough for arbitrage to kick in. As we go forward, the difference between these arbitrage bands, it reduces, it becomes narrower, while it gets impeded during this period when it coincides with the subprime crisis. And ever since, we do see that the bands are becoming narrower and narrower, and it seems that the capital account has become more liberalized over a period of time, though it was impeded during the subprime crisis period. Now, a couple of more observations that we do see it alternating between effective controls on outflows to effective controls on inflows. And yeah, so I'll just quickly go to the conclusion part of it. So we use a relatively underutilized price-based measure that uses deviations from covered interest rate parity. So we bring in the NDF market, which is a phenomenon that exists for countries where the capital account is not fully convertible. India seems to have become, based on the results, we find that India seems to have become more financially integrated with the global markets, as demonstrated by the CIP deviations going to zero and narrowing arbitrage bands. And the policy implication is that as an inflation targeting country since 2016, and if the capital account is becoming more open or liberalized, then there is limited room for stabilizing currency fluctuations. Thank you.
Super, thanks so much. Josh, over to you. Josh?
Sorry, I'm not seeing this as a an option to pick up my PowerPoint.
Oh, can you share the screen? Oh, there.
How about, yeah?
Yep.
Okay. All right. So, all right. So, unfortunately, as Sanjeev mentioned, while I was sleeping last night, and it's the morning where I am, I got a new version of the paper, and so I'm really commenting on the old version, although I don't think it's changed so radically. And in any case, I have managed very quickly this morning to change the charts. So let me start and try to move quickly. I've simplified the title to Cal in India. Now, hold on, slideshow. Okay, here we go. So the question the paper tries to answer is, how free is India's capital account? And the traditional research approach to this is to just look at the restrictions that prevail on capital account. But there are two problems. The first is that de jure is not the same as de facto. There are always loopholes in any regulation. The second problem is that not all restrictions have the same importance, and you need to net them. So for example, and I'm going to come back to this later, so please note, in 2008, there were 11 easing measures, and there were 4 tightening measures. So on balance, was the capital account liberalized or tightened? A priori, we don't know. 2018, same story. Now, the standard measure is the Chinito measure, and that is completely useless because that measure, which is based on an analysis of the restrictions, shows no liberalization whatsoever. So that's kind of our benchmark. Is this really possibly true? All right, so this paper tries a different approach, and the logic is absolutely brilliant. What it says is that liberalization means greater linkages between domestic and foreign financial markets. So if there's more liberalization, that means there can be more arbitrage between the two markets. And all we really need to do is test how well arbitrage is working. All right, so they employ a specific test, and the specific test is covered interest parity. Now, covered interest parity says that domestic interest rates have to equal foreign rates plus the expected depreciation of the currency. Otherwise, financial market investors will arbitrage. Now, in particular, expected depreciation is measured by, in effect, the difference between the forward and the spot rate. And so, in other words, people playing in the markets, if the domestic interest rate and foreign interest rate are out of line, they can play with, invest in the forward rate or invest in the spot rate in order to arbitrage these differences away. Now, so the key point I want to make here is that CIP works through arbitrage. All right, so what does the paper find? It finds that CIP does not hold, by and large, restrictions have some impact, but, and this is the key finding in a way, deviations have diminished sharply over the past decade. So the implication is the capital account has become much freer. Now, the key chart here is this no arbitrage bands, which chart, which shows that they've diminished, particularly after the 2010 period. Right? Now, why does this finding matter? That's the first important question you really need to ask. And the reason why this finding matters is because it's absolutely critical for monetary policy. And I want to set out two cases. One is where arbitrage is perfect. If arbitrage is perfect, then the domestic interest rate must equal the foreign rate plus the expected depreciation. Now, if you peg the rate, that means the expected depreciation is zero. And that means that if you peg the rate, your domestic interest rates cannot deviate from foreign rates. And the implication is that the RBI must choose between setting interest rates and targeting the exchange rate. And that's the famous trilemma. Now, if arbitrage is imperfect, and that's what they find by and large, then the RBI can target both interest rates and the exchange rate, but it's going to be costly. Why is it going to be costly? Because if you intervene in the foreign exchange market, that means you're purchasing dollars and printing rupees, and that's increasing the money supply, and that's going to fuel inflation. So you need to sterilize that increase in rupees by selling bonds. And selling bonds is costly. Let's say that bonds cost 6%. So if increasing interest rates is going to attract 10 billion in arbitrage, then the annual cost of sterilization is going to be $600 million. Now, if it attracts 100 billion in arbitrage, the annual cost is going to be $6 billion. So clearly, if there's a lot of arbitrage, the RBI will be much more reluctant to target the exchange rate or target interest rates at the same time, right? Now, this is not a theoretical case. In 2007, capital inflows reached 9% of GDP, and the sterilization costs were absolutely enormous. So the point I'm making is the precise results of the paper, whether there's a little bit of arbitrage, a lot of arbitrage, that is absolutely critical for monetary policy formulation. It affects whether they need to take the trilemma seriously or not. Now, so then, since the precise results are really important, we need to know how reliable are they. So the first thing that you want to check is the paper's investigated price, but what about quantities? We know that if there's capital account liberalization, there should be, in general, more capital inflows. But if we look over the past 10 years, there's no trend. So immediately, that should set off alarm bells.
Just your 2-minute warning.
Yeah. Now, if you look at a longer term picture, what you see is that there was a trend of growing capital inflows, but that's really the trend takes off in the early 2000s and reaches a peak in 2007. And so by this measure, just a crude measure, it looks like the early 2000s were the period of liberalization, not so much afterwards, right? So let's look at what the paper shows is the trend in CIPs. Now the deviation in CIPs. Now the paper finds 6 periods. If you look at the 6 periods, you see that the CIP goes up, it goes down. It's not really obvious that there's a trend toward zero here. It tries to explain this by talking about tightening in certain periods and loosening in certain periods, but this is really circular reasoning, right? If you find that the CIP moves from positive to negative, you say that means there are controls on outflows, but we don't. As I said, that's circular. It doesn't prove that the net was a control on outflows. We have to investigate that quite separately. And we also have to consider the possibility of reverse causalities here, which I won't get into because I'm running out of time. The key chart here does show that after 2010, there is a decline in the no arbitrage bands, but I wonder whether this is econometrically robust. I would just note that the chart that I got this morning differs considerably from the chart that I was dealing with yesterday. Right now, so what is the work that I would like to see done? I'd like to see a few things. First, I'd like to see cross checks between price and quantities. Do the deviations correlate with capital flows? I want to see that on a trend basis. I want to see this through short-term event studies. I want to see really whether the flows are smaller when the deviations are within this so-called no arbitrage bands, before I believe that these are really truly no arbitrage bands. And if they're not, I want to know why not. I also want to see cross-checks between prices and regulations. For example, when a tightening regulation is introduced, do we see that leads to higher CIP deviations? When a loosening regulation is introduced, does it reduce the deviations? Again, we can use the event studies. Then I want context here. CIP doesn't necessarily hold even in advanced countries. So I want to know how do the CIP deviations compare to other countries, particularly the BRICS, and I want to know how the no arbitrage bands that we're finding in India compared to the BRICS, before I get some sense as to whether India's capital count is relatively free or relatively restricted. So my conclusion is this is really, really important work. It's exceptionally clearly written. It was a real pleasure to read. It's interesting preliminary results because we're coming at it from a very interesting and useful perspective, but I'd like to see a whole lot more cross-checks before I accept the conclusions, particularly given the importance of this for monetary policy, and I really look forward to the final version.
Super, thanks. So we've got about 9 minutes. Sanjit, I don't know if you or other co-authors want to respond rather quickly, or we should save time for other questions in any event.
Thanks, Adam. Actually, Josh gave us so many things to work upon. I think we'll have to dig deep and come back with a revised paper. So nothing to comment on as of now. This is all for future work, and we'll work on it and get back. Nidhi, do you have any response?
Yeah, I want to add here, Josh, thank you very much. A lot of food for thought, and your comments were very, very useful. One point I want to make is with respect to the event studies around tightening and control events, and we did think about it. There is a problem there in terms of interpretation, and I think the problem is that again, we cannot weigh every tightening at the same scale, right? Some tightening event could be stronger than another loosening event. So when we did a simple event study, it did not incorporate that part, and therefore our results became quite ambiguous, and that was the reason we did not take it further. But we really need to think about it harder, and as you also mentioned, we agree that this could have significant implications for monetary policy, and as we go forward we will work on these, and we will keep bothering you later as well with as we move forward with this paper. But thanks a lot, very, very useful.
I'd be happy to be bothered because, as I said, I really think this is important work and it's really promising work.
Thanks, Josh. Yeah.
So it looks like there's at least one question in the chat, Malay. I don't know.
Yeah.
If you wanted to.
Can you bootstrap out the crisis regime around the financial crisis to make a case of continued?
Yes, so I think what my suggestion is that this is one period that was around 2008-9, the financial crisis that has increased it has kind of got the arbitrage banned RI. So I think one thing you could possibly try to do is bootstrap that period out. So which means like you simulate data from the normal distribution of the other periods so that you can see the continuity in the band diminishing.
Sure. Yes. Thanks, Malay. We will surely think about it and determine how we can implement it in a manner that doesn't adversely do address the main concerns here. Sure. Thanks.
Any other questions? Here's a question from Partha. Shall I read it or do you want to unmute and ask? Okay, and then so despite the RBI permitting onshore banks to deal in the NDF market, we don't see too many Indian banks dabbling in that market. Any reason for that?
I'm not. Yeah, Sanjit, do you want to go ahead? Okay, let me take that question. So I am not particularly aware of why Indian banks do not participate as much in the NDF market, but for sure it is a foreign bank dominated market. And it could be that there are certain restrictions which either directly or indirectly do not allow Indian banks to participate, but we do not have an answer to it.
Of course, I mean, Indian banks, I mean, foreign banks have been active in this because they could take care, get advantage of the arbitrage opportunity they could with their entity, one on onshore leg and offshore leg, both are the place they had the entities. So that has been traditionally, they have been the main players in this market, but Indian banks have been permitted almost a year, I think, RBI has permitted, but no Indian bank is really getting into it. There are, I think, some practical issues. I think there may be some legal issues. It's worth for you to maybe looking into why it is not, because it's one of the important steps to integrating this NDF market to the onshore market.
Sure. Thanks, Partha. I think in March only around COVID, after COVID, they announced this.
Yeah, around that
measure.
time.
So,
I think.
yeah.
But nothing much has been. One more, suggestion. I think in some of the conference, RBI, ex-RBI senior executive directors, etc., also talked about it. There is one restriction in onshore market for getting it integrated with overseas market is this insistence by RBI on underlying exposure details, and that's a huge restriction, and that's time has gone. It's hugely archaic, outdated, and has run its time. It's absolutely unnecessary for in today's context. RBI must get rid of it, and then only the Indian market will get Indian rupee market, dollar rupee market will become much more vibrant and also flexible. third point I have is that RBI is the biggest player trader in the market. They decide whether to buy dollars and accumulate reserve, or when they want to, when rupee is under pressure, then intervene to the extent an undefined word like undue volatility. That undue, what is undue is never defined properly. So that, skews the market, and everybody tries to guess in the market. All participants tries to guess what RBI action would be. And that's very unfortunate. I mean, the RBI should get out of the let the rupee be, if necessary, volatile, at least to some. Otherwise, you be there on the buy side, you be there on the sell side, and restrict the movement in a narrow band. Entire market collapses, really. That's it.
So Partha, actually, interestingly, we started off with this question as to how RBI is affecting these things, these CIP equation, especially these deviations. It was difficult, as in we couldn't come up with an econometric method strong enough to tease out that, but happy to hear suggestions on that if there is a way to study that. Thanks for your comments.
Thank you.
Okay, so if we've exhausted questions, then thanks very much to the authors and to Josh, and let's